Hello traders, welcome to a new video on simplified arbitrage trading. I would also like to say that my Fibonacci trading guide is going to be available till August 2nd for a 20% discount if you enter the promo code in below. So if you want to check that out, you can check out the website. So what we're going to be talking about today is how can we use triangular arbitrage to just buy undervalued and sell overvalued, but instead of switching from one coin to the next and one coin to the next to get that arbitrage profit, and what instead we're going to be looking at is buying a coin and then selling it back at a higher price, because we expect that our other arbitrage traders are going to be pushing that rate up. Now, that's not probably going to make a lot of visual sense right away. So what I'm going to do is show a quick hypothetical back in the farmer's market example again, of how exactly this is going to work. And then we're going to use that to look at some live rates and some models that we can build to find ways to exploit undervalued and overvalued arbitrage opportunities. Imagine you are at the farmer's market again, and you have 4 bananas. And with those 4 bananas, you have 2 options here. We can either sell them for 5 apples. So we would sell 4 bananas, we would buy 5 apples, or we can sell those 4 bananas and buy $5. Now let's quickly just write an exchange rate of what this would look like. And we're also going to assume that 1 apple is equal to $1, which of course wouldn't be possible here, but imagine that the market is inefficient and that an arbitrage opportunity is available. So let's take a look at that right now. The first thing that we want to look at is bananas for apples, and what that's going to be is actually 1.25. I'm going to explain how and why that's 1.25 a little bit below here. But we also want to look at bananas divided by dollars is going to be equal to 1. We exchange 1 banana, we get $1. We exchange 1 banana here, we get 1.25 apples. And what we also see is that so an apple divided by cash is equal to 1. So we do have a mismatched price opportunity here. But to quickly just explain why I put that, let me do a little hypothetical here. So imagine that BTC USD is equal to 10. This means that you can buy or sell 1 BTC for 10 USD. So we can go to a vendor, we can sell $10 and buy 1 Bitcoin. Or we could go to that same vendor, we could sell 1 Bitcoin and receive $10. But what that also means is that we can buy or sell $1 for 0.1 Bitcoin. So if we wanted to exchange our Bitcoin for dollars, we could just say, here to the vendor, here's 0.1 Bitcoin, he would give me $1. Or what I could also do is, if I want to buy Bitcoin, I could just say here's $1 and I would receive 0.1 Bitcoin. Now to relate that to the example up here, bananas and apples is 1.25. And what this means is that I can buy or I could sell 1 banana, so 1 B, for 1.25 apple. But what I'm probably going to want to do here is sell all of my bananas and buy as many apples as possible to try to exploit this. So I'm probably going to be selling bananas and buying apples. But what this rate also means is that I can buy or sell 1 apple for the price of 0.8 banana. And I got this because it's just 4 divided by 5, so banana divided by apple, and this is just going to be apple divided by banana, which is 1.25. Now, many of you might already know this, but this is called the quote currency, and this is called the base currency. So what this means is that this exchange rate here means 10 of the quote currency will buy you 1 base currency, 1 Bitcoin. What this means here is that 1.25 of the quote currency of Apple will get you 1 banana, the base currency. So whenever you look at a currency pair, you want to quickly just identify what's the base, what's the quote, and how many of the quote currency is going to get me the base currency. So here 10, here 1.25. Okay, so here I think it may be apparent what would likely happen in this market with what we would do. So if we were the only trader, we would immediately just sell these 4 bananas, buy the 5 apples using this exchange rate here. We would then probably want to just sell those 5 apples into dollars. We would receive $5. And then we'd probably want to just sell those $5 to buy 5 bananas. So we would start with 4 bananas and we would receive 5 bananas. We would just keep exploiting this over and over and over again, where we would now have 5 bananas. We would sell those 5 bananas for 1.25 times 5 apples. We would trade those apples back into dollars and then back into bananas. This is good, and this is guaranteed to be profitable in this kind of example, but the market's going to be very different, and bots are going to be very quickly exploiting these inefficiencies. And also, fees rack up when we do use this once, then we use this, then we use this. That would be 3 fees. What we can actually do is only pay 2 fees, and not just pay the 2 fees, but stay in the same currency and use triangular arbitrage at the same time. So to explain exactly what that would look like, let's imagine what would happen if thousands of people were trading in this farmer's market. Well, what's going to very, very, very rapidly happen is that this market rate is going to move down. The reason I say that is so many traders are going to be selling their bananas to buy apples that they'll be selling this exchange rate. So if many people are selling this currency pair, that is going to bring the pair's value down. And also many traders who have apples are probably going to want to convert them into dollars. And that's also going to bring the pair down as well. So what we want to do here is, well, first of all, what would this rate go to eventually? Well, this rate is going to go to 1. And the reason why I say this rate has to go to 1 eventually is because any value above or below 1 is actually going to be, there is going to be an arbitrage opportunity. But we know that this rate's going to go from 1.25 to 1 very quickly, but how can we exploit this? And especially on the way down as it goes down. Imagine that we get B divided by A, so base divided by quote, is actually equal to now 1.1. What do we want to do? Well, we still want to sell as many bananas as we possibly can to buy as many apples as we possibly can. And the reason is because we can still arbitrage this profit, even though it's a little bit smaller. Even if this rate was 1.02, so a 2% inefficiency in the market, we would still want to arbitrage that if our fees were low enough. So really what I'm getting to here is we don't always have to just convert and complete the triangle of the arbitrage. But what we can do is buy an undervalued currency pair. So in this example, we are buying apples because apples are undervalued. And we are going to be trying to hold those apples until they're at parity. Now, I don't want to introduce too many new words here, but parity, P-A-R-I-T-Y, just refers to when an exchange rate cannot be arbitraged, so that there's no inefficiency in the market. And you're going to see many rates are at parity, and not many are going to be not at parity. But we can still look for rates that are inefficient and try to exploit those by buying the undervalued and then selling that undervalued pair immediately when it goes back into value. Okay, so with that, let's look at just a quick and easy model and a trade that I made using this kind of scenario. All right, traders, let's take a look at buying and selling undervalued and overvalued coins using triangular arbitrage. So this is going to be looking at 2 things. First, how I was able to turn 10 Ethereum into 10.326 Ethereum in a very short period of time with very little risk. And we're also going to be looking at how to build models to do exactly this kind of trade. So the first thing that I noticed was that HOTF at this price at 908 and 930 Central was severely undervalued. So I bought as much HOTF as I could, which is exactly 10 Ethereum, and I sold it back at 157. Again, I don't mean overvalued and undervalued in the supply-demand sense. I mean it in the arbitrage sense of looking at a rate as undervalued when if you were able to arbitrage that rate, then this rate would be the rate that you probably want to buy. And a rate's overvalued if the rate that you probably want to sell, that overvalued rate, if you sell it, it would go to the arbitraged rate. So to show that visually, let's go to TradingView, and let me just show, this is currently at the BTC and the price of Bitcoin. Let me just show how exactly I did this. So to find what HOTF should be, I did HOTBTC divided by FBTC on the same exchange. And then I hit compare. I added in HOTF. So I added in that, and let's disable percentage, and here it is. Now, the reason I'm doing this, HOTBTC divided by FBTC is theoretically HOTF. But what we're getting here is, what we want to find is, when is HOTF not at parity? When is HOTF not at the rate that it actually should be? And that is when we step in and we arbitrage. So if we go to 908 and if we go to 930, the two times that I bought, this is HOTF I bought here, and I bought here, 930, before the run-up. So I was actually able to buy, as you can see there, because what I noticed was this. I was looking at HOT, and I found it was trading at parity here. Let me just blow it up a little bit. Yeah, so it was trading at parity here. It was still trading at parity here. It was still trading at parity. And then it began to drift down out of parity. As you can see, it was drifting down. It went down to 151 and went down to 152. Those were the two lows. And when it did that, I found that there were some serious arbitrage trades that were available. And because of that, I just bought HOTF and I sold it when it reached back into parity. So really, one thing that may be confusing at first that I really think is important to explain is why this rate keeps bouncing from, like a low here into a high here, and why I'm saying this is, actually undervalued when you're probably thinking the rate's here. The rate's jumping from here to here because HOTBTC, the offer is currently at 9 Satoshis and the bid is currently at 8 Satoshis. So what that means is that every time someone sells, the rate's just going to go down to here, sells HOTBTC, and every time someone buys, the rate's just going to go up to here. So I'm not really interested in where the rate is currently for this, but what I'm more interested in is the highs and lows of this rate in the 5-minute time frame. So you can see here that the high was here and the low was here. So if I was able to buy HOTF here, and it was beginning to climb back into parity, which would be the top rate here, then I could make an arbitrage profit. So that's exactly what I did. I bought here, and I sold it at 157. So let me show that again. I sold it here at 157 at 959. So that was here. The reason I sold at 157 was the rate at parity was 159, but I thought that there were going to be many offers at 159, many bots who are trying to sell at 159, so I just put it a few ticks below at 157. I perhaps could have gotten out of parity at 158, where I could have bought this and then sold it back at parity at around 158. Now what you may notice now is, let's not just look at that previous trade, but what would we want to do in the present moment? Well, we'd actually probably want to buy HOTF and immediately sell it back for a nice little arbitrage profit. To actually do that, let's go to HOTF. We would want to place a limit buy order at 155 or even at 156. But let's say we place a limit buy order at 155. Let's say we spend 1 Ethereum. We would receive this much HOT. Now let's go take a look. Well, now we would have to probably buy at 156. So let's say we bought at 156. Let's go take a look at what the rate is at parity so we know what rate it's likely to climb to. So we know that parity, it's at 160. So we probably want to sell at the 159 or the 160 price area or order book. So if we buy here and we sold conservatively at 159, then we would receive a profit of, let's just type it out, 641,025. That's how much we had bought here. We would receive a 1.922% profit, so 1.9% profit, which would be about a 1.75% profit after fees of 1 buy, 1 sell. So no need to take in 3 fees and try to do triangular arbitrage, but just buy undervalued and sell when it goes back to parity. You could also try to buy an undervalued currency if you believe, and not sell it at parity if you believe that the parity rate's just going to continue to move upward. Then you could just hold that trade. But that would be using supply demand, and this is using just arbitrage dynamics. Again, when we are looking at rates at what they should be and what they shouldn't be, the order book does matter a lot. As you can see, there are many offers of traders who are trying to trade, very likely just bots, who are trying to sell it around the parity rate of around 159, 158, 160, these rates here. We still can potentially take advantage of this, especially if 157, if the offer of 157 went down to, like, let's say 5 Ethereum, we could try to buy potentially at 157 and then try to sell at the 159, because we expect price to climb to parity as it would here, to climb to parity here. So the reason why sometimes you might lose money with this kind of trade is, imagine that HOT BTC divided by ETH BTC, so the indicated rate for HOTF, if this began to move down, the high of this began to move down, then you probably will just want to exit your trade at break even or exit your trade at a slight loss after fees, because then this would not be available. But that doesn't really happen that often. As you can see, it's pretty much smooth sailing here, where you can, buy when the rate is undervalued and inefficient down here, and then sell it when it reaches back to parity immediately, back up to here, and then just keep doing that. So let's take a look at just another random coin, and let's build an arbitrage model to try to find if we can exploit any type of lack of parity here or inefficiency in the market. So let's go back to HOTF, and we can see that traders are beginning to buy 157, making that rate probably climb back up to parity. So if we look at just the coins such as these, let's talk about BCN. So to build our model for BCN BTC, I'm going to do BCN BTC divided by ETH BTC. I'm going to overlay BCN F here. Now what we can see is that this rate is not trading at parity. We can see that it was at parity here as it was at the low. You can see that here would have been a really good arbitrage opportunity as this rate continued to fall, but we could have just taken advantage of that fall and just immediately sold here. But that would be actual arbitrage, which would have been fine. And you can see it traded at parity here. And now we're down here. So what this kind of looks like to me is that we could buy the undervalued BCNF, which is here, and merely try to sell it at these offers, at these, offer at this sell level here. So buy it around the 611, 612, and then sell at parity, which is about 620. So let's go take a look at the BCN order book just to see if we would be able to pull this off. So if we look at BCNF, here, we can see that many bids are climbing up here because many bots are looking and seeing that this rate is undervalued, and they're wanting other traders to market sell so that their bid orders get filled. What we could even do is we could try to buy at 6.1, so it's 6.10, to front run this limit order. Let's say we spend 1F. And then let's say that we want to, you can see traders are just going to keep buying this up because this is inefficient. We know that this is probably just going to keep going up. But let's say we're lucky enough, we put one out at 6.1 and someone market sells to us and our bid order gets filled. We would get 163.934 BCN, and we want to sell at parity. And the parity rate is 920 to 922. Let's look at the order book here. Looks like we have a slightly larger 621, so we want to sell at 620. So let's sell at 620 here for that same amount of BCNs. That would be that. And we would receive a 1.63% profit if this rate climbed back to parity, which it likely will. And we would only probably want to take a slight loss of maybe 0.5% or even less if the high of this rate began to climb down to here. Then we just probably want to get out. We might actually want to hold this trade and not sell at 620. If BCN BTC divided by ETH BTC just continued to move up, we would just hold this and wait until it got to parity. Then we would exit the trade. So this isn't the only way that we can use to look at what a rate should be. We can actually just flip around this formula to make it tell us something a little bit different. So let me look at actually this. Let's do BCNF times FBTC. This is going to give me the indicated rate for what BCN BTC should be at if arbitrage was perfect. And you can see here, this is the blue line is what BCN BTC is actually at, and the candlesticks are what the mathematical calculation says that BCN BTC should be at. You can see that there's really just not much arbitrage. And even if we go to SCF, divided by SCF times FBTC, and then overlaid SC, overlaid SCBTC, we're probably not going to find many arbitrage. Yep, not going to find many arbitrage opportunities of divergence. Reason that is it's a lot easier for us to trade undervalued and overvalued and find those on Ethereum pairs than it is to find them on Bitcoin pairs. So whenever you're looking at one of these, we're not really interested in this exchange rate as much as we're interested in something like this, MPXS divided by FBTC. And this is going to give me, again, that what the rate of MPXF should be. We can try to exploit that inefficiency here. As you can see, the rate is trading at 651 and it should be at 658. So you're probably going to see many bids already piling up here, but potentially we could try to buy here and immediately sell here when price climbs right back up. And you can even see here that price does have a history of just climbing right back up to parity as it did here. It dipped low, climbed right back up to parity, and then it dipped right as MPXS BTC divided by FBTC dipped to. It stayed at parity, and then it stayed at parity here until here. And then there would be an arbitrage opportunity for buying MPXS F. So that would be buying this pair. Yeah, and of course there are many bids piling up here, but if we were to buy, let's say, one at 653, which is a little bit aggressive, but we could try to snag that market right there. We would probably be able to sell at parity at around, let's say, 659, I think, was where parity was at. So 658, to be honest. This is not going to be a massive profit, but it'll be something. So that would give us if we spent 1 Ethereum and bought at 653, so just immediately market bought, we would receive 153,139, 153,139 for about a 0.76% profit. Yeah. Or we could even try to bid at 651 and try to front run that guy, spend the 1F, we get 153,609. Then we would get a 1.07% profit if our 651 got filled here. And price just climbed back up to parity as it does here. So what I do want to show here is that this is not what every single kind of indicated rate and actual rate is going to look like. We can do this for other kinds of pairs too. So if we want to look at, let's say, Binance Coin. So I'm going to go to Binance Coin here and show you guys just how we would be able to arbitrage that. Let's just do RPX, just because I feel like doing RPX. So for that calculation, I'm going to do RPX BTC divided by BNB BTC this time, because we're going to be translating this into BNB. So we're going to do RPX this. And here it is. So we can see times where it's overvalued, times when it's undervalued. Here's a beautiful opportunity to sell RPX BNB. We really want to sell it here, and then immediately we can buy it back at probably a much better price. Or we could even try to buy RPX BTC and immediately sell it to the BNB pair here for triangular arbitrage, because there is a really nice difference between these two, as you can see here. It can also help to go in the 1 minute too. If you really want to see fine-tune, discrepancies, I could do 1 minute for. If I wanted to do this to F instead, I could do this, and then I could just switch this to RPXF, and you'd be able to see, you could snag these rates here. You could snag these rates here and immediately try to sell when it goes back to parity, like something like this. Many opportunities available. Weird looking candlesticks, I know, but many opportunities available for many of these kinds of pairs, even though it is trading at parity here. If we go in the 5 minute, you can just see it's basically trading at parity. So I'd recommend looking around and trying to find different kinds of coins that have inefficiencies like this, and then try to calculate the indicated rate of what the rate should be, and then try to also see what the rate actually is, and then you can try to just trade to buy when the blue line is underneath the candlestick, and then just sell when the rate reaches back to parity. You're paying 2 fees, you're not paying 3, and you're just taking advantage of value relative to the cross rate here. So I know this is a lot again, probably just as complicated as my previous video on triangular arbitrage, but this is just another method that one can use to try to scalp triangular arbitrage without even converting the coin to anything. Do be careful though, we always want to almost always use limit orders when we're trying to do triangular arbitrage and trade like this, because using market orders can get us in at a bad rate where we're actually trading basically at parity, which isn't good. We want our bid order or our offer order to be filled, and then we want to try to sell that for a higher number at parity, and price will likely eventually reach parity unless the indicated rate begins to climb down, and if it does, then you probably just want to get out. So yeah, that's going to be it for this video. If you guys have any questions on exactly how the triangular arbitrage works, or taking advantage of overvalued and undervalued, you can shoot me an email, or I also offer one-on-one mentoring as well if you would like to do that. So with that, happy trading.